Okay, here we go. This is the purpose of managerial accounting. In this part, we're going to overview the difference between financial accounting and managerial accounting. This is going to be a three-part lecture, so just hang on to your hat and know there are three parts. I'm going to try to keep them under 8 minutes so it's not so painfully long to sit and listen to somebody talk. So this is our first one, and this is the purpose of managerial accounting. Obviously, it's for managers and it's for making decisions. Even though financial accounting gives us a lot of information, it looks at the past rather than into the future. And managers need to look into the future so they can plan, so they make long and short term goals, and so that they can create budgets. And then they'll come back and they'll look at the measurement and the evaluation and kind of guide what they have planned. So managerial accounting's a little bit of a different animal. And if you compare it to financial accounting, there are a couple of really big differences. One, users. Financial accounting, if you remember correctly, were for outside people. Board of directors were interested in it, but a lot of people are more interested in the bottom line if you're making money. The IRS is really interested in it for tax purposes, obviously. But managerial accounting is more internal. It's for the managers, the employees, the decision makers inside, uh, so that they know what to do in the future, or they hope they can figure out what to do in the future. The purpose of the information, I've pretty well said that. Financial accounting is for others to make decisions or that they want to invest in you. And the managerial accounting is to help a manager do the planning into the future. It talks about flexibility of reporting. If you remember in 101, we talked about GAAP and FASB, and there were certain regulations that we had to follow. With managerial accounting, that's not the case. There's no strict format that you have to follow. The important thing is if the information is good for you and will help you make a good decision. So you also then look at how often you can get that information. Basically, for financial accounting, a lot of times you had to wait to the end of the period to find out what the stats were. With managerial, you can do a quick report anytime you want, uh, and it'll kind of give you an idea of what's going on and what's going to happen into the future. It talks about also, and I mentioned this earlier on, the financial looks at what has happened. Managerial is going to look at what is going to happen so that you can help predict the future and also help guide what happens in the future. So, two different ways of looking at that. For the forecast of the information is basically with financial, it looks at the whole organization, and that includes, the administration, the selling part, everything. Whereas when you're doing managerial, you're looking at more sections, you're looking at processes, you're looking at projects, you're looking at even down to the department level as to is this department performing as they need to. And finally, you look at the nature of the information. And the nature of the information, obviously, with financial is monetary or money. Same thing with your managerial, only there are other considerations. There's considerations of the environment, there's considerations of the customers, of how you set your business up, and the implications of that. So there's a big difference between the two. I think the managerial accounting you will be more relaxed with. The big thing with managerial is everything we've kind of taught you about cost, we're going to kind of tear that apart now. There are two types of costs that we look at, and this is just the beginning of the type of cost. So this will be really a brief overview. There's such costs called fixed that don't change when the activity changes. And there are variable costs that change in proportion to the activity changes, i.e., rent doesn't change whether I make one widget or 20 widgets. The rent on the building is still the same. But my material costs go up. The more widgets I make, the more material costs go up. That's a variable. And we're going to decipher and tear that apart so you can figure out the differences between the two. That becomes very important when we're doing break even. Then we're going to look at, okay, how do we trace these costs? Are they traceable to production? And if they're traceable to production, are they directly traceable to the part or the product? Or are they a supporting part of that product? If they're a supporting part of the product, they're an indirect cost, which means I can't trace it to one individual item, but if I don't have that cost, I can't produce that item. So that's an indirect cost. The other type of cost is one that, again, I'm going to use materials or labor. If I if I'm using steel to make a pin, that steel that I use, okay, is directly relatable to the pin that I hold in my hand, right? Same thing with the labor, the person who put it together. Now, the person who supervised the whole thing is an indirect. So you have direct labor costs, you have direct material costs, and you have indirect material costs and indirect labor costs. So those two classifications you got to keep up here in your head also. And then there's classifications by function. You've got direct labor, direct material, and manufacturing overhead that all go into the product. But then you have period costs, and we had period costs back in financial accounting, and those are the selling and the administrative costs. They don't do manufacturing, but again, they are supporting the whole organization to be able to do the manufacturing. So you have product and you have period costs. And finally, you've got a whole schematic of all of this. You have period and product cost, right? Period costs are expenses that go to the operating expenses on an income statement. Product costs go to inventory. So you can see you've split things up now. So inventory that gets sold is cost of goods sold. Inventory that stays in the inventory goes into raw materials, work in process, or finished goods. So you're kind of splitting up the product costs. And then inventory that's sold in 2006 out of this group becomes cost of goods sold for 2006. You can kind of see the flow of it. This is really kind of nice because we're looking at how these costs split down. You know, you have direct materials at 45%, which is a good portion of a product. Direct labor is at 15%, and the overhead is pretty high at 40%. You really concentrate on the factory overhead because how it's applied makes a big difference on departments and the product itself as it flows through. And I'm going to stop here. I'm at 8 minutes and 40 seconds. And the next thing we look at is going to be a breakdown of materials, labor, and factory overhead. Thank you. So this is part one.